How much can you safely withdraw from your retirement savings accounts? Well, instead of talking to you about different theories or rules of thumbs, I'm going to show you guys a client who's currently withdrawing too much in the retirement savings account. And if they continue, what that'll look like. In other words, when they'll run out of money. And we'll talk a little bit about solutions on how they can overcome that challenge. So without further ado, let's jump into a Google Sheets that I built for today's episode. So please don't forget to like and subscribe to the channel, as that will help me continue to make these educational videos for you and your peers. So here we are on the worksheet, but before we get started, full disclosure, this is for educational purpose only and should not be taken as financial or tax planning advice. With that said, I built this easy little calculator in Google Sheets. At the top I have total investment, so that'll be equal to your retirement savings. So we could just say here, retirement savings. That'll help kind of clarify what it is for most of you. And we're going to start this client out. This is not the client we're going to talk about today. I'm just going to give you guys an example around a figure so you can kind of see how the math works in the calculator. So we got $100,000 retirement savings. And we're going to say this client needs an additional $500 a month. You know, the difference between their Social Security and their expenses, they're short about $500 a month, and $500 multiplied by 12 is $6,000 for the year. Now, the advisor fee on average, you're going to see anywhere from 1 to 1.5%. I like to plan conservatively. I'm going to shoot for 1.5%, because if we plan high and you end up with 1%, things would look better. So let's start high at 1.5%. And then the rate of return. Well, for average retiree, we're looking at 4 to 6%, because you're not going to be as aggressive within your portfolio when you get to retirement, because you're now dependent upon that savings. So you don't want to put yourself at risk of throwing the dice too hard and following big losses in the market plus your withdrawal. You could really put yourself at risk of running out of money sooner than you thought. So 5% is what we'll use for now, because we're going to have a conservative portfolio. So there we go. If we scroll down here a little bit, we've got a few different columns. The first is just the year associated with the balance of the account. And we have the starting balance in that next column. So we've got our 100,000 there. And then the following column for withdrawals is the $6,000 we'll be taking annually. We've got an advisor fee of $1,500, 1.5% multiplied by the $100,000. And then we have interest earned of $4,625. Some of you might wonder, why isn't this equal to 5% of the 100,000, which is 5,000? That's because for conservative measures, I've gone ahead and applied the interest after taking the withdrawal and the advisor fee, taking the withdrawals. And the reason for that is because we don't know when you're going to receive interest to your account or a withdrawal. And typically what makes more sense from a conservative standpoint is to go ahead and take the withdrawals and fees first, and then multiply the remainder by your return. That way, if things end up positive here when we're running the numbers, it's very likely that you can achieve whatever's been put forth in the hypothetical, because in the real world, it's a little more favorable. Usually fees from advisors are charged monthly or quarterly, and your returns are going to be, the market, you're in the market, it's fluctuating, but it's growing usually on the daily. It's up and down, but over time, the market's linear. And so you should have some growth, then you'll have an advisor fee, then you'll have some growth, then you'll have an advisor fee. That's the more natural flow of your returns less your fees. Here, again, it's conservative. We want to take the withdrawals first and fees, and then we want to apply our interest. And I'll show you what that means in just a moment. So since this is not $5,000, we took $7,500 from the account. And this is not equal to that amount. So while we're negative for the year, we've taken more than what we've earned. And we see that here because we started with $100,000, but our ending balance is $97,125. So we already see that this is not a great place for the example client, right? Because their cash, their retirement savings is depleting. They end up with a lower balance at the end of the year than what they started with, because they're taking too much from the account. So we got $97,125. Let's look at the following year. So in year 2, we start with that $97,125. We make our $500 monthly withdrawal, $6,000 over the year. And then our advisor fee is lower because the balance of our account is lower. And that's normally what advisors, when they're charging you, it's based upon whatever the gross account balance is. And in this case, it's now 97,125. So 1.5 multiplied by that amount is lower than it was when it was 100,000. And then we have interest earned. Well, interest is less than the previous year because the balance is lower. And when you add that to the balance after the fees and withdrawals, you're now at 94,152. And that pattern happens for the next several years, all the way up until, gosh, right here toward the end of this 25-year. I use 25 years, assuming that a lot of people retire at 65. That'll push you to age 90. And, on average, we're going to live to about, in our mid 80s. So 90 is most of us will not outlive that 90 or, outlive 90. So 25 plus the 65, that 90, that's why I use 25 years. And it looks like you would have ran out of money just before your 90th birthday, sorry. You would have been about 88 or so. So that's not terrible. This is a pretty good situation for this example. Let me go back up and change a couple things. So let's say that annual withdrawal is a little higher. Let's say they needed $7,000 per year. What happens in that case? Well, we have our 100 minus our 7, and then less our fees, and then plus our interest. But our balance is a little lower this year. Now, we know we're on the schedule for depletion because we went higher on our withdrawal. So the account would deplete faster than it did in the previous example. But look at how many years we lose because of just an additional $1,000 per year, which is, $80 a month or something. We are now out of money at the 19th year instead of the 24th. So we go from running out of money at 88 to running out of money at, 65 plus 20 minus 1, so 84. So we lose about 4 or 5 years there, just for a $1,000 difference. And now let's just say something like the client needed $12,000 per year, $1,000 per month, which is, $1,000 a month doesn't seem like a whole lot when we're thinking about how, the rising cost of goods and services. And so that's $12K, and then plus the advisor fee, so you're now at like $13,500. Your interest earned is only $43.25. Your balance on the account is about $91 for the year. More importantly, if we fast forward on down, we're out of money by year 10. So the difference between taking $6,000 and $12,000 per year, your account balance at 5% per year, starting with $100K, and a 1.5% advisor fee, would literally be zero by the time you got to the 10th year, instead of pushing us all the way out into the 20s. 20. We looked at about 19, and then 24. So now I'm going to give you a demonstration of a client that we are working on who came to us with a little more than 100,000. So we started with 225, and they are taking $1,250 a month. Let's see, I have it on the top of my head. So they're taking $1,250 a month because $250 of that $1,250 will be paid to Fed and state tax. So we're doing like 20 on the Fed and 5 on the state, and so that's $250. They're taking net home $1,000 per month. So pretty close to our example, but we've got the tax built into this one. So if I take that over 12, it's $15,000 per year. So I'm going to say $15,000 per year. Our fee to the client on this is about it's actually 1.5, because the way our table works, it's anything from 0 to 250 is 1.5, which is actually competitive, especially with inflation. All advisors have been lifting their fees. Rate of return, and right now we're in cash for this client because the markets are so volatile. So if we assume this client continues doing what they're doing today, what they've done since the beginning of the year, this is how the balance of the account looks. So we've got the wrong amount here. We have one extra zero, 15,000. So in that first year, we've got $225,000 balance, but we withdraw 15,000. We have an advisor fee of $33.75. We have interest earned equal to 0, so that needs to change. Well, no, that's right because we're in cash at the moment. Ending balance is 206. In the following year, 206 less about 18 between the withdrawal and the advisor fee, no interest earned, assuming that next year it's likely we're going to get back into the market here soon, but we're just going to assume all years are 0. If we just laid in cash for the next 10 years, we're at 188, and I'm just going to go ahead and keep moving. How long, the question is, how long can we continue making those withdrawals? 15,000 plus the advisor fee, even though the advisor fee gets smaller and smaller before we run out of money. And this client has 14 years. At the 14th year, so call it 13 years, because by the 14th year, they're actually out of money. They can no longer make, no, I'm wrong. It's the 15th year. So they'll make it through year 14. Client is about 65 now, a little older than 65. I think 67. So 14 years. It's not terrible, 67. So you're at 71. So you're at 81. I think that comes out to 81. So that's not too bad, but you know, that's taking a pretty big risk. Now, what I'm going to do here is show you guys a rate of return that's closer to that 5% that we talked about earlier. And if we scroll down and we take a look at when this client runs out of money, things look a little better. We're seeing interest coming back here, right? So we're taking 18 in that first year from 225. We see $10,000. So we're down by about 8. That's not as bad on the account value, the account balance. And we can see that our balance lasts quite a bit longer. Now we're pushing out to we've run out of money by year 21. Now we're getting to a place that's a little more comfortable because if the client's 67, that's about 88. It pushes the client to 88. We're almost at 90. We like to see the money last forever in perpetuity, but oftentimes that's just not the case because people need more. They're not, you know, the cost of living has gone up, is too high, and their Social Security benefit is not keeping pace, nor are their pensions. So this is just something we see very often where people are upside down on their income versus their expenses. So they're taking a lot from their retirement savings accounts. So looking back at this is a lot better. And the question is what rate of return would this client need in order to have capital preservation? So I'm going to go up to 8% for a moment. And we're going to see if this client can withstand those withdrawals. That gets them through 25 years, but we still see capital depletion. So what would it take to have at least capital preservation? Let's jump up by another 2% to 10%. And now we're looking at something that's a little closer. That's actually capital appreciation. The client's benefits are growing, account balance is growing, and that's easy to see because the withdrawal plus the advisor fee is only about 18.3, but the interest earns about 21. And so if the interest here is greater than these two columns, then you should have capital preservation. And if it's more, if it's equal to, then it's capital preservation. If it's more, then it's capital appreciation. The balance of your account is growing. So this is probably somewhere closer to 9%, we'll say. And if we go 9%, yeah, I mean, we stay right around, we float up above the 225, but we're pretty close there. So as a summary, we can see that this client's $225,000 account less their $15,000 annual withdrawal minus the advisor fee plus interest at 5% is not enough. And eventually they would run out of money in retirements. Now they get pretty close to that age of 90, around that 5%. It's not terrible, but it's not enough. What you really want to achieve is not a zero balance by the time you pass, say, age 90 or even 100. What you'd like to see at minimum is capital preservation, where your account balance is equal to the same as it was when you started on the day you die. And even better would be capital appreciation, where there's more in that account than what you started with. For this client, that ends up being about 9%, and I got to admit that's pretty high. What I'm going to do next is I'm just going to assume that for the client, we would go ahead and take their 225 and invest that directly into, say, the S&P 500. Just as an example. Now, the S&P 500's done about 9.5%, 10% over the last 50 years since it was incepted back in the 1950s. So it's not a bad place to start because we need to hit about 9, and it's done that. So we're going to go ahead and take the last 25 years of the S&P market's historical returns, and I'm going to create a little randomizer. I'm going to show you guys how it works in a minute, where we can change the sequence of returns. We can change in what year those returns happen. And I want to show you guys the difference of that output. And then we'll get an idea if the client could sustain those withdrawals and the fee over that same 25-year period without having a negative balance in any one of those randomized cases. Right now we see at 5%, which we could do pretty safely. I'd feel confident about that. The client still runs out of money a few years short of age 90. So there's still quite a bit of risk there. Can we do it with the S&P knowing there's more risk because we're shooting for that 9 or so percent, we're getting closer to 9 or 10%, are we able to, with more certainty, make it all the way through? So let's jump over and back to the Google Sheets where I have that little randomizer built, and I'll show you guys how it works, and we'll run a couple scenarios. So we're back in here, and I'm going to go ahead and scroll down a little further where I've built this S&P buy hold historical. So this is the starting balance of 225 we saw from above. Here's our $15,000 annual withdrawal. Here's the advisor fee we saw above. And then we have this interesting little area here where we have the S&P historical year of return and then the actual return. So we have 2022. This is as of last week, yesterday. I built this on Friday of last week. So that would have been, for full disclosure, that would have been the 14th minus 5 days or so. No, this was built Monday, I'm sorry. So 2 days ago, the 12th. I just got to say that as full disclosure. So as of the 12th, 2022 year to date on the S&P, this would be lower today because of what the markets did yesterday. Anyhow, 2021 all the way down, all the way down to 1998, okay? So I have all the returns every year for the S&P 500. You can see them here. The red is negative or 0, and the black is positive. So 25 years. And then on the column just next to that, we see the gain or loss. So if it's a negative, we know that that's a loss. I could also make that red, but we know it's a loss because it's denoted by the negative sign. And if it doesn't have a negative sign, then it's positive, what we earn for the year. So loss and gain. And then we have an ending balance on the far right column. So we can see in this first year, 2022, since we're down, not only do we have the withdrawal and the advisor fee of $18,000, but we also lost $30,000 in the market. So our 225 becomes 176 pretty fast. So that's 4 is 8, 20, let's see, that's 24. Yeah, so we've lost 50K, basically down $50,000 in that first year. Now in the next year, we start out with our 120, our 176. We have our advisor fee and withdrawal here. And the market is up 26.89%, so we gain back 42,000. Not enough to make up what we lost, but we're on our way back. Don't forget, it's harder to make up losses because if you think about if you have an account with, say, $100,000 and you go down, you lose 50%. You're down to $50,000. How much do you now need to earn in the market to get back to your 100,000? The answer is 100%, right? Because 50,000 multiplied by 50% what we lost is only 25,000. You'd be at 75,000 if the market does 25%. You would, or 50%. You would need to do 100% because 100% of 50,000 is 50,000, and now you're back to your 100%. That's why even with this big return, double this, we're not quite there at the 225 we started with because it's harder to get back what you lost. In addition, like I said earlier, is that I am taking withdrawals and fees first and then applying the interest earned, and that also makes this more conservative, so these numbers don't look as good. But if we keep moving, here in year 3, we've got our withdrawals and our fee. Market does 16%, we're at 29. And so if we just kind of follow that logic down, all the way down through the ups and downs, down here at the year 25, 1998. That's nothing. This has nothing to do with the year. We're just using the historical returns here, but we're assuming we're down here at year 25, right? We're just using previous performance to go forward. And we've got $57,000 left in our account. We've barely made it. Okay, so now what I'm going to do is show you guys a little graph. So what we have, we know that the client, if we go, you just want to adjust this back to what it was. It randomized it while I was moving it. So if I just put this back in order, sort range, sort, we see that $57,000, what the account ended with on that 25th year. Client passes away and the beneficiaries click 57,000. Now, when I hit randomize, it's going to change the order of these years. It doesn't change the return associated with the year. That'll stay the same. So for instance, when I click it, let's just remember year 2020 was 16.26. So when I change it right now and I randomize it, you'll see that this is in a different place, but it's still 16.26. Okay, so let's try that. So let's go down here and hit our little randomize button. I'll come back up and I'll look for 2020. And there it is. And it's 16.6. So that's the same. But we see that it's no longer in the order it was before, from a descending order from 2022, 2021, and so on. Now it's 2004, 2003, and what it's doing is it's just changing the year that return took place. So we call this sequence of returns, and all it means is that if you have losses during the initial years of retirement, that's more detrimental for your retirement than having those losses later. And there's for more than one reason. I'm not going to spend time explaining that. Let's get back to the example. But it's just important. You'll see why. The account balance, when clicking on that randomize button, will always be different. So now we see that if this happened in a different order, we see some of those big losses later on here in retirement. So this client didn't lose as much earlier on, and therefore their account, when they took those hits later, was big enough to kind of, the balance after that bigger hit was still fairly sizable. It was, almost 3 times that 57,000 that we had when we just ran it from 2022 on down to 1998. And let's press it again. All right, so let's push this back up there to the top. So now we have a $60,000 balance, about what we had in that first from 2022 to 1998. Now in this year, we're negative. We see our little chart here on the right, negative 200,000. We would have ran out of money in this sequence, at year 15. Not good for the client. Try it again. We see we're up 65,000, so that's pretty good odds so far. And we're down on that very final year, so that's pretty good. Here we are out of money at year 14, so close to what we saw before. So we wouldn't have made it through. Here we're out of monies at year 18, wouldn't have made it through. And here we've made it through with 15,000 left by the skin of our teeth, 158, 137, 130. We lost, we're out of monies, that's by the 18th year, something similar to that we saw from earlier. We made it through here by the skin of our teeth. We're out here again by the 18th year. So you can see that, it's either we end up in a pretty good place or not at all. And so you have to start asking yourself, is that the type of risk you want to take? I mean, it's a throw of the dice here for this client. Well, that's pretty close if you ask me. It looks like a 50-50. We'd really have to run it over about 1,000 sequences to get a better understanding if the client ends up positive or negative more often than the other. But it looks to be about 50-50. And so you have to ask yourself, is that the type of risk you want to take as a retiree? That you've got like a 50% chance of running out of money 15 years into retirement. And so you're just kind of hoping that you pass away before then. Where the best case is the other 50 is that sure, you make it through all 25 years with a little left for your beneficiaries. I would think that most clients would not be willing to take that type of risk on. So going back to our example, that means this client has to make some decisions because they're set out for depletion of their account. And they're not going to, it would be foolish for them to risk investing their monies in a place like the S&P 500 over the next 25 years and taking just rolling the dice that hard. So I'm going to jump back and we'll talk a little bit about what some solutions could be for this client using the calculator. So we're back here in the plan, and the question is, what recommendation could you make to a client in this situation to keep them conservative from running out of money during retirement while making, some of that income up that they need monthly? And the answer is pretty straightforward, is that they have to spend less. They got to figure out how to cut their expenses, maybe do some tax planning and strategize in order to reduce their overhead, their monthly expenses. So right now we're at $15,000. That's going to have to come down. They might be able to work with their advisor to get down their fee. That's going to be tough, but I'm going to go ahead and drop that from 1.5% to 1%, assuming that you see a client like this and they really need some help. Maybe there's a trade-off on hours that you put into their planning that you'll work so that you can get their fee down by 30% or so. Now, up here on annual withdrawals, because they'll still run out of monies at 1%, no doubt. We can see that if we scroll down. They're still out of monies at the 23rd year. So let's see if we spend a little less. Let's go down to 14,000 and see if we can't make it all the way through. We're pretty close. We're 1 year away. And if we go from 14 down to 13, now we're good. We don't have capital preservation. We are depleting the account balance, but we're doing it fairly conservatively. And we get down to the 25th year, that client's last check will probably bounce. Again, this is built as a conservative model or calculator anyways, because I'm taking withdrawals first before interest is earned. And so naturally the account will have done better. This would be a bigger balance over that same period of time. If I come back up and we go to $12,000 and $1,000 a month, we really got to do some magic with the CPA and tax guy. Let's go ahead and see what that ends up meaning. Well, $80K. So they're leaving, about $71,000 to the beneficiaries. That's not looking too bad. It's not the capital preservation that we want. They will be depleting their capital, but the client could take $250, reduce their monthly withdrawal down to $1,000 from $15,000 a year, which was, they were at 15,000 divided by 12, the 1250. So they're at 1250. They're at 12 now. And we were also taking $250 for tax to be straight there. So that $1,000, if we did the same thing, is closer to, we were 20% on the federal and 5% in the states, 25%. They'd be at $750. So they're going to lose $250 per month as income. However, they will have a much better chance of making it through retirement with that small adjustment. So there you go. So wrapping it up, we see that the client's going to have to make some changes. They're not going to want to hear it, but they're going to need to reduce their monthly withdrawals. They're going to have to reduce their expenses in order to make that retirement savings last the next 25 years. Now, for some clients, that'll be easier than others, but for this client, they're going to give up about $250 per month in order to do that. However, in my opinion, that is going to be a much safer option than taking the chance at higher returns, because they're going to have the risk associated with those higher returns is too great and puts them at risk of running out of money within a much shorter period of time. Having to sleep knowing that within the next 10 years you could be out of monies, it will not sit well with most people, especially retirees. And so my suggestion and recommendation for someone that looks like this would be to reassess their expenses and work with a financial advisor to help budget down or restructure some of their debt in order to get their taxes or just their cash flow up, or those expenses and liabilities down to a place that's manageable, so they can depend less on taking those higher withdrawals from these retirement savings. Thanks again, guys, for tuning in, and hope to see you in the next episode.